makers and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Of course, the conversations that matter. And here's what's coming up on today's program. The Treasury sell-off pauses, but the souring mood in bond markets actually raises a stake for today's much-anticipated U.S. jobs data. Well, Amazon's outlook tops estimates on strong e-commerce sales. Apple posts lower-than-expected quarterly iPhone numbers. We'll dive into these figures. And the Bank of England governor tells me it's too soon for the U.K. to declare victory in the battle against inflation.
It's the last mile, which obviously where policy is really doing the work, and we're going to have to see policy stay restrictive. It's going to have to remain restrictive to have this effect of bringing inflation down, and particularly next year.
Well, let's take a look at the European markets map. Now, they have been fluctuating quite a lot. For the moment, we're seeing gains across the board. The CAC actually gaining 0.5% here in the UK on the FTSE 100. Just look out for WPP. It's been we're going through a pretty big sell-off, and this is because they said that a lot of the tech advertisers won't spend as much on advertising going forward. The DAX gaining some 0.4%. Look, there's one thing that all of these market traders and all of these market participants want to know, and that's exactly what happens with U.S. jobs. That'll be a little bit today, not only the number, but also wage growth. And of course, it will influence, presumably, what the Fed does. And that could change everything. We've had a very big week for Treasury. So let's look at the 10-year for the moment. But if you look at Treasuries, I want to look at the 10-year and the 2-year. The 2-year, of course, more sensitive to interest rate decision. Look, if you see some of the big moves that we've seen, partly it's also investors trying to digest news of the $103 billion in upcoming U.S. debt issuance. And there is a little bit of concern whether the market can actually absorb all of that supply. You can see the 10-year currently 4.1770, so it's stabilized a little bit since last night. Now, the other story is the food index. This is the United Nations July FAO food price index, and it's risen, or it's rising to 123.9. We'll have a full breakdown, of course, of what we're expecting in terms of, for example, grain prices and supply because of what's happening in Ukraine and Russia with wheat. Now, let's also move on to tech. Amazon's latest revenue forecast topped estimates. Apple's results not so solid, with a third straight quarter of declining sales. So let's get straight to our Bloomberg tech reporter, Aggie Cantrell. Aggie, good morning. So what were actually the key takeaways from Amazon?
Yes, so AWS is really the focus for Amazon. It is their real growth driver and has been for quite a while. It's really important to see that Amazon is also a company that has really driven, even though we all know it as the online marketplace for everything, it's really actually AWS, which they see as a real play going forward. And especially once we've already seen so many companies shift from on-premise to the cloud, there was a fear around the growth driver that was AWS, because you've already got those customers for it. But actually now what we're seeing is essentially you have been able to manage to also look at how artificial intelligence can play into continued development of cloud infrastructure. And that's the same as we've also been seeing with Microsoft, and that's their big investment in OpenAI. With Azure, that was all about their cloud infrastructure. And you see this with Google as well.
So how is Apple being affected by the broader slump in smartphone sales?
Yes, so the real concern with Apple is essentially they have iPhones that is a critical part of their business. This is over 50% of all their sales are iPhones, and they are seeing the effects of a broader slump in smartphone sales that has essentially come because consumers are worried about their bank accounts, they're worried about inflation, and they're holding on to old devices, and there just isn't the same market as there was before. And that's a real headache for them, because really the thing is for Apple is that they're releasing new iPhones. They're releasing one soon, but they're also projecting that this slump will continue into this quarter. And those 4 consecutive quarters, if this current quarter also sees a slump in sales, that will be the longest time that they have had without any with declining sales in the last 20 years.
Aggie, thanks so much. Our Bloomberg tech reporter there, Aggie Cantrell, with all of the earnings news that we had over the last 15 hours. Now, joining us to explore both tech and the wider markets, BlackRock Senior Investment Strategist, Laura Cupo. Laura, thank you for joining us. I don't know what you do with tech right now. So tech is one of, I guess, the most exciting but also concerning in terms of valuation sectors that there could be.
Well, I think there is still scope for the tech rally to extend, perhaps not at the momentum that we have seen year to date. Earnings did come through a little bit above expectations. If we look at the surprise around those earnings beats, came in about 9%. And if we think about, is there actually profitability, cash flow behind this AI hype? Clearly that is the case. And if anything, there's probably a bit more upside to those earnings. That certainly was some of the guidance that we saw from those mega cap companies. And as well, if we think about kind of the CapEx spending, that's going to be a crucial gauge to watch in the coming months. And I do think there's probably still scope there, especially given the broadening out of that rally. We really need to see more improvement in the cyclical side, and we're not yet seeing that come through.
So when could that come? Is it difficult to call?
I think it is difficult to call because markets seem to be already pricing in that so-called soft landing. We are seeing some signs of improvement in some of those cyclical gauges like auto sales, housing is surprising. But then manufacturing in the U.S. has been in contraction for about 9 months. And we do think that as those rate hikes really continue to weigh on financial conditions, that is going to prompt a deterioration in that economic data. So those cyclically sensitive sectors of the economy, we think are going to continue to be under pressure. And so getting exposure to those equities that are tilted to that, we think is too premature.
Laura, I know you don't talk individual stocks, but let me tell you about our big number because it's a good number. And this is basically the Apple $1 trillion valuation, which is at risk. Is there, I mean, if you look at what is priced to perfection, so we chose Apple just as our big number because it's the new thing we're doing this week. We love just to pick a big number, but is there a big sector that you worry about in terms of price to perfection away from tech?
I mean, I think if we think about, the consumer discretionary, the communication services, those heading into the earnings season, had fairly upbeat estimates. We think they're going to struggle to materialize those 12-month forward earnings expectations because we do think the consumer is going to be under increasing challenge. Where we are looking for opportunities, though, is where those sectors are already pricing in that recession risks that we do see come through. So whether that's energy, for example, with very depressed expectations, depressed valuations, and as well looking for those other pockets. For example, industrials in Europe have been fairly resilient. They've participated in that upside despite German manufacturing being in contraction for quite some time. So there is potentially still upside there because of the sector composition towards airlines, towards growth demand tilt. So probably more opportunities in those sectors that aren't pricing in that perfection.
Okay, so interesting. All right, the U.S. jobs number. This is like the big number, non-farm payrolls. Do you worry that there's underlying small trends that actually there could be a downturn in the economy that may not show up in terms of that U.S. non-farm payrolls number?
I think that is actually the case. So yes, we're probably going to continue to see this moderation in the pace of hiring gains. Crucially to watch will be those wage components. So average hourly earnings should start to decelerate more meaningfully at the margin. That should provide some lift to the Fed. But ultimately, the unemployment rate still kind of that 3.6% mark, historically low. We could start to see further pressure on that because we do think that that is artificially kept down because of the supply constraints that are coming through in the economy. We've started to see some of that labor force participation come back in the working age population, but on a whole, we do think there was a structural shift in that supply that we're not going to get back to those pre-pandemic levels. That has implications for the broader kind of labor market where we may, that number is probably misleading in some sense.
So interesting, Laura. Thank you so much. Laura Cooper stays with us. Coming up, the Bank of England delivers its 14th straight rate hike. More from our interview with the Governor, Andrew Bailey. That's next, and this is Bloomberg.
We do see policy now as restrictive. Interestingly, I think the Federal Reserve and the ECB have said something similar in the last week or so, actually, which means that we do see policy acting to bring inflation down. It's having the effect that we would now, and of course, there's a lag in the transmission of policy, so it's not a surprise that we've had to wait for a while for this to happen. But we see the evidence now, so that gives us a sort of basis for now saying what's going to happen here on. And what we're really saying is, look, it's going to have to remain restrictive to have this effect of bringing inflation down, and particularly next year. A lot of this year, we're going to see inflation come down rapidly, but that's A lot of that is the unwinding of things that happened last year, energy and so on. It's the last mile, if you like. I use this sort of term sort of a bit loosely. It's the last mile, which obviously where policy is really doing the work. And we're going to have to see policy stay restrictive. Now, the question then is for how long?
Right, that's the question.
Now, I'm afraid the answer is because we don't know at the moment. That's why we say for sufficiently long to have its effect, because it's too soon to judge really how long that's going to take. And the reason is that I think, because we've now, I'm much more confident now that it's on the downslope. Mm-hmm. But of course, people want to see that, they want to really believe it, they want to build, and then it gets built into people's expectations, it gets built into price setting, it gets built into wage setting. We've got to see that happen.
But Governor, so do you believe it? Could you say actually you're victorious right now?
No, I'm not going to say we're victorious. That would be, I think, far too soon to say that. What I see is much more solid evidence that it's coming down. We've been, in a way, the number we had a couple of weeks ago, we've been waiting for this number for some time because there were a number of puzzles to us in the inflation numbers which just didn't seem to really reconcile with what we were hearing, and this gave us more confidence that we're seeing it.
But why put that wording in the guidance? What are you worrying about?
Well, I think what we're saying to people, that there's a path in the market where rates go up and then they come down. Yeah. There's another path which we laid out today for illustration where, well, what happens if you keep rates essentially where they are today? Now, interestingly, both of them return inflation to target, and there's no doubt some other paths we could draw on a piece of paper to get the same effect. What we wanted to say is, look, before we get to the point when we can really say with confidence, this is getting behind us, we can start to maybe bring rates down, we've got to see a lot more evidence. So they will have to stay, policy will have to stay restrictive for a sufficient period of time to get to that point.
But is this the new normal in terms of interest rates?
Oh, the current level?
Yeah, the current level, more or less. Like, will we ever go back to what we had in the last 10 years?
Well, I would be surprised if we go back to near zero interest rates. I think something's going to have to happen that we currently don't know about. I think if you do all the work that's done on sort of equilibrium rates, of where might the rate settle, that would suggest it's lower than it is today as a sustainable rate, but actually nowhere near down to where we were in the sort of the period post the financial crisis. But we're not. That's uncertain, and we're not yet there to the point when we can start reaching, I think, firm views on that.
Well, that was some of our interview with the Bank of England Governor, Andrew Bailey. Now, BlackRock Senior Investment Strategist Laura Cooper is still with us. Laura, when you look at the Bank of England, I mean, they kind of have all of the concerns of other banks, plus it's a small open economy, so that gets exacerbated. I mean, he's using very similar language to what we heard from the ECB, right? It's like higher for longer. Is it because this is a new phase, or he just wants to change his communication style?
I think it's an element of changing the communication style in the sense that central bankers have now clearly abandoned forward guidance. What struck me yesterday about the Bank of England was there's this common thread among the three major central banks that we've seen over the past week. The first is they are going to be data dependent, which does set up for bouts of volatility around those upcoming event risks. They are suggesting that rates are already in restrictive territory. That's a kind of new language from what we saw before, suggesting they're nearing the end of their tightening cycles. And then, interestingly, they're all kind of signaling the fact that the growth deterioration at the margin is starting to feed into their calculus of further policy rates. So that, to us, does suggest that central banks are really in this environment where it's not so much how high, but really for how long. And that's really where market focus is going to be. So
do you think there's now a general concern that if they over-tighten, that, then it becomes a policy mistake?
I think it's too soon to tell whether that's the case, because I do think we are in this new macro regime where inflation is going to be elevated. But I think markets perhaps have to get their head around the fact that when they say sufficiently restrictive for a sufficiently long period of time, that could actually mean we're going to see significant deterioration in economic activity, and they're actually going to hold firm at those elevated rates. So markets are pricing in those cuts coming through for the Fed next year. Perhaps that's still a bit premature. So I think that's really the key challenge. And in terms of positioning portfolios, it keeps us cautious on actually tilting further out the U.S. curve, taking that duration exposure because of the uncertainty there.
Right. I mean, the Treasuries were on the move, let's say diplomatically, this week. I mean, I know there are a number of factors that probably led to that, but is the number one the fact that there's 103 billion in terms of issuance, and we're not quite sure whether the market can absorb that supply?
I think that was a key catalyst this week to send those 10-year yields well above that 4.1% mark. But I think it's less about the level that we're seeing in that rate. It's more about the pace of the moves that we've seen. And I think that's why we've seen equity markets react to that renewed rates volatility. Now, going forward, we probably don't expect kind of the magnitude of steepening that we have seen in that curve to persist. If anything, we do expect bouts of flattening mixed with steepening on the back of those economic data prints coming through. But yes, the steepening trade is probably one that is going to be more pronounced over the next 12 months or so. We probably need to see the Fed signal that pause, signal that cuts are, in the pipeline for us to really have strong conviction that that is the place to go. Because when you're getting 5%, near the front end of the curve, it's very hard to take that duration exposure.
All right, BOJ.
Yes.
I like that. I mean, the BOJ surprised twice.
Yes.
Like, do they not? Is the yield curve control now gone? Is it a matter of when, not if?
I think last Friday was a step towards abandoning the yield curve control. I think it's probably too soon for that to kind of take hold right now.
Yeah.
If anything, we do think that yields are going to drift higher, both in Japan and, but mild implications for the global yield complex. What we're watching for is the currency. We do think the currency has scope for potential further weakness, and that really could be the pressure valve that perhaps prompts the BOJ to actually change that policy because of the inflationary impact. So it's not a Q3 story per se, but it's certainly something that's on our radar.
Great. Thank you so much for joining us. Of course, Laura is the BlackRock Senior Investment Strategist. Laura Cooper joining us on, everything that happened this week and all of that in TV time in 10 minutes. Laura Cooper. Coming up, Crédit Agricole reports a surge in profit for the second quarter. We'll hear from the French lender's deputy chief executive. That's up next, and this is Bloomberg.
Making M&A transactions in the field of wealth management is not a new strategy, but we conceive these operations, as always, as simply a complement to the capacity of growing organically. And our wealth management business, Suisse Wealth Management, is growing organically quite significantly, and we thought that this opportunity of acquiring the group Peter Carn would be a nice complement.
Well, that was Jérôme Grivet, the Deputy Chief Executive Officer at Crédit Agricole, on the French lender's wealth management operations. Now let's stay on the European banking story. Joining us now is Bloomberg's Tom Metcalf, who, of course, oversees all of our banking coverage here in Europe. So lots of news from Crédit Agricole today. Tom, what's the highlight?
Yeah, I think it is that deal. So they're buying that Belgian wealth manager, and clearly there is that strategy to become much more dominant in that space. And we understand the reason behind that. More recurrent revenue, much more stable. So it's an interesting deal. And then those earnings, as you sort of look a bit further, very, very strong. I think they were described as consensus busting by our analysts. So really strong performance by Crédit Ag. Their shares are up. A much more interesting story at Commerzbank, actually, where basically they were communicating about buyback, but I think they've disappointed the market by not having enough detail. And whether that was a sort of a deliberate move, maybe there's some pressure behind the scenes not to do that, or just generally bad comms, is really interesting because most analysts are throwing their hands up in the air.
Yeah, I was going to say, actually, if you look at some of the other continental banks, I mean, it feels like the French are actually in a little bit of a sweet spot. Is that unfair? I mean, they seem to do better than others. Is it because of their positioning or execution?
Yeah, I think that's been the theme. Like BNP, SocGen have all done really well in recent days. I think it's sort of that happy accident of timing. They're still sort of benefiting from that rate rise boom, and also just been well sort of positioned in their market. Like the French market's relatively strong. But I would also say across the big continental markets, it's been a pretty strong set of earnings, which does sort of contrast slightly with the UK, whereas a bit more, so we're further along in the rate cycle and they're sort of starting to see those net interest margins get crimped.
Is there anything that shareholders look at? I mean, apart from valuation, and some of these banks, you don't really know how they'll grow in the next 5 years, but, what are some of the questions that shareholders are asking themselves?
Well, I think, first of all, is that question about banking itself, right? Where the political pressure can sometimes come on. It's obviously very heavily regulated, so that's that big sort of uncertainty looking forward. Like, what is sort of going to be the kind of political posture towards banks as they make more and more money? But largely it is the interest rate story. It is how much money they can make out of their deposits and the deposit beta, i.e., how much they can kind of resist giving on to their consumers. And in Germany, they've done a pretty good job of keeping as much of that as possible, which is why you see some pretty good results there as well.
So, really quickly, what are valuations looking like? I mean, I think, about 6 weeks ago you came on and we kind of looked at the numbers, and a lot of U.S. investors think that Europe is a mess. Is that still the case, even for European banks?
Yeah, all the price-to-book values are still, well below 1. Even the best performers, really. I think maybe 1 or 2 of the Nordic banks are above 1, which is pretty common for many of the big US banks. So no, there's this huge disconnect. Yeah. And you look at that, it's quite interesting because, as we know, in the US, they actually have higher capital requirements in some areas. So I think it's just a sign of the different views people have on those economies.
All right, Tom, as always, thank you so much for joining us. Tom Metcalf, there, head of UK bank coverage. Coming up, Donald Trump pleads not guilty to charges that he conspired to obstruct the 2020 presidential election. So we'll have plenty more on that next. And this is Bloomberg. The Treasuries sell-off pauses, but the sour mood in bond markets raises the stakes for today's much-anticipated U.S. jobs data. Amazon's outlook tops estimates on strong e-commerce sales. Apple posts lower than expected quarterly iPhone numbers. And the Bank of England governor tells us it's too soon for the UK to declare victory in the battle against inflation.
It's the last mile, which obviously where policy is really doing the work. And we're going to have to see policy stay restrictive. It's going to have to remain restrictive to have this effect of bringing inflation down, and particularly next year.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, some of the conversations that we're having with Governor Bailey yesterday, of course, concentrated on private sector wage growth, what that meant. They're still expecting that to be at 6%. Those are the Bank of England predictions. And then we just have that breaking news out of British Airways. The Unite union that has been trying to get the workers a higher wage have just announced that they will actually get a 13.1% pay rise. So that's great news for, of course, a lot of the workers, a lot of people that have been struggling with the cost of living crisis. I'm not sure what that does. If you see a big sector move on that, what that does to some of the BOE projections. Now, Donald Trump has pleaded not guilty to charges of conspiring to obstruct the 2020 presidential election. Bloomberg's Kaylee Lyons has the details from Washington.
Former President Donald Trump was arraigned for a third time on a rainy Thursday afternoon here in Washington, D.C., where he pleaded not guilty to 4 criminal counts related to efforts to overturn the results of the 2020 election. Those counts including conspiracy to defraud the U.S. and conspiracy against rights. Now, also at this hearing, the magistrate judge set the date for the next hearing, the first before the judge who will actually oversee this case, Judge Tanya Chutkan. That date is set for August 28th at 10 a.m. Eastern Time. Though the former president will not be required to appear, that is when we understand the judge will actually set the date for Trump's trial in this case. Now, as for what this means for the former president and his ongoing campaign to seek the White House again in 2024, after he left this courthouse and arrived at Reagan Airport, he did briefly speak with reporters and say that this is persecution of a political opponent. And as we have seen in his prior 2 indictments, the charges brought against him have a tendency to actually boost him in the polls. When he was first indicted in the state of New York in that case related to hush money payments paid to porn star Stormy Daniels, his poll numbers went up and he raised millions of dollars, and he has also seen his polling go up since he was indicted the first time federally in Florida related to the classified documents case. So we'll wait and see how this affects his campaign as he is going to face trial dates in the primary season of 2024 and also mounting legal bills as he fights all these different challenges. In Washington, Kaylee Lyons, Bloomberg News.
Well, joining us now to talk about all of this is Thomas Gift. He's director of the Center on U.S. Politics at UCL, University College London. Professor, thank you so much for joining us. When you look at what we've learned over the last 2 to 3 days, I think a lot of people will have questions about the polls. It seems that the Republican Party has not only continued to support Donald Trump, but in some cases doubled down. Is he that popular with the voters?
Well, it's great to see you, Francine. Thanks so much for having me. I think that he is with a section of the electorate, roughly 30 to 40% of Republican voters. I think Trump's primary opponents in particular, though, are really caught in this purgatory because they can either attack Donald Trump at the risk of alienating the GOP base, or they can defend Trump at the risk of just allowing him to cruise to the nomination untouched. There's really no good option. And I think that's why, among other reasons, Trump has such a commanding lead, and we do continue to see increases in the polls for him. Every indictment seems to help him and muzzle his Republican rivals. Former New Jersey Governor Chris Chrisley has really been the lone voice arguing that Trump's legal troubles should be disqualifying. But most of the field, they've soft-pedaled the issue, or they've actually defended Donald Trump's witch hunt claims. It will be interesting, I think, as we get closer to the debates, whether any of Trump's competitors pivot and adopt a more punishing stance. But for now, they're seeing the same polling that everyone else sees, that Republican voters overwhelmingly, 70 to 80%, think that most of the charges brought against Trump are politically motivated.
Does it change fundraising and his campaign on that at all?
Well, I think it's kind of a two-edged sword. Certainly it helps him with fundraising. If the last two indictments are any indication, he's gotten a really significant surge of money. But at the same time, there are reports that a lot of money is being dwindled from his campaign and being funneled into these legal battles. I mean, they're certainly expensive. They're protracted. He's hiring essentially armies of lawyers. And so that's money that he can't just maintain in his war chest for Iowa, New Hampshire, and the rest of the Republican primaries. But at the same time, given the fact that he has roughly a 30 percentage point lead, I'm not sure if money is really the key issue, at least in the primaries. I mean, that may be a different story in the general election.
So, Thomas, what happens next? I mean, I know there are questions on whether the former president will face jail time, if he can actually run from jail. Is there anything that could happen now that would put voters, off him?
But, I think Donald Trump's tactic is just going to be delay, delay, delay. And in cases like this, prosecution is obviously going to try to move this trial swiftly, but deference really goes to the defendant. So I wouldn't be surprised if it goes really into the heat of the campaign. If Donald Trump would become president, then he could essentially eliminate this court case altogether because, of course, the Justice Department is under his purview. But I really don't see anything changing with Donald Trump, especially if we assume he's going to get the nomination. I think voters have, in large part, made up their minds simply because there's not a whole lot of new information that's being divulged. We already had the second impeachment trial that centered on January 6th. Then there was the House Select Committee, plus everything surrounding the effort to decertify the election results. Voters got to see for themselves on January 6th itself. So that's why I'm just a little bit skeptical that this is really going to move the needle on public opinion.
So, Thomas, if you look at where we are now, do you really think it's Trump against Biden again? And what does Biden have going for him?
Well, I think that Donald Trump is certainly the prohibitive favorite, and it would take something monumental to topple him from his front-runner status. And so I think all the odds suggest that we are going to see a re-election campaign between Biden and Donald Trump. And the remarkable thing about that is that, both are so unpopular that they could actually lose to the other, which is kind of stunning. Biden is, I think it's going to be a referendum essentially on Donald Trump, more so than it's going to be on, Joe Biden's presidency. Of course, Democratic voters have been energized by some things that have happened over the last couple of years, like the Dobbs decision on abortion. I think the economy, it kind of cuts both ways. It used to be the case just a few months ago that Bidenomics was kind of a clear net negative, but now we've seen some withering in inflation and, employment continues to be strong, so that's a plus for him. But I think ultimately voters are going to say, do we want Donald Trump in office again? And that's going to be the real question.
Yeah, and how do you think, what will they ask themselves in terms of questions? Is it the economy, or do they just have an attachment to Donald Trump because he says he's anti-elite? He's different to anyone else the U.S. has ever seen, frankly.
Absolutely. I mean, I think for any other election, we would look to the economy because that's such a good indicator for the success of an incumbent president. But I think what we might be seeing in 2024 is something unique, which is just, do I want Donald Trump in office, given his character, given everything that it has happened up until this point, all the baggage surrounding efforts to overturn the election. You know, there's a certain fraction of the population that is just sort of Trump or else. There's a certain fraction that is never Trump. And so, you know, it's going to be determined by energizing of the base, but particularly probably a small fraction of swing voters, maybe 5 to 6% of the electorate, who are going to, you know, determine the outcome. And that's going to happen in the same number of predictable swing states: Pennsylvania, Wisconsin, Florida, et cetera. And so to some extent, you know, these national polls are telling, but as we know, it's really just these battleground states where the election is determined.
Thomas, do people care about, you know, the Fitch rating, actually? I mean, you know, do they talk about it for a couple of days, maybe in the paper, and then it dies down? Or will they blame President Biden for it?
I'm sorry, I didn't hear your question, Francine.
On the Fitch downgrade, on the downgrade of the U.S. economy, do people care about? Is it something that people will still be talking about come Election Day?
I think probably not. You know, certainly it's not good news for the White House. An unnamed senior official just described the downgrade as bizarre and baseless. And we had Janet Yellen come out and say that the move was arbitrary. I mean, Fitch is essentially defending their stance by saying that there's been a real deterioration of standards in governance. And I'm not sure that you can lay the blame squarely on the administration simply because it's largely a function of sort of all the dysfunction we've seen in Washington that it was exemplified very openly with the national debt ceiling debate. And that goes to both Democrats and Republicans. I mean, usually it is the case, anything that goes right or that goes wrong, blame or credit is attributed to the White House. But in this case, I think there's plenty of scapegoating to go around on both sides of the partisan aisle.
Thomas Gift, thank you so much for joining us today, director there of the Center on U.S. Politics at UCL. Now, we're also getting some breaking news out of UK for data. July construction PMI actually rising to 51.7. The forecast was 48, so it's better than expected. Anything above 50 indicates, of course, an expansion. Now, Credit Suisse was an icon of the Swiss economy. Its collapse was a huge blow to the national psyche that many thought could trigger a profound change to the way the country works. 4 months on, and Swiss banking is back to making money, and there are few signs anything will change. Oliver Crook reports.
The demise of Credit Suisse ripped through financial markets, and it shook the nation of Switzerland to its very core.
It was no longer possible to restore the necessary confidence, and that a swift and stabilizing solution was absolutely necessary. This solution is the takeover of Credit Suisse by UBS.
UBS intends to downsize Credit Suisse's investment banking business and align it with our conservative risk culture.
Despite outrage, shock, and disappointment, months later, silence has fallen back over the Alps. The question, is this Swiss serenity a sign of stability or of complacency? Switzerland is not known for swift changes. Women, for example, only got the right to vote in 1971. And with a closed-door, government-brokered deal, backstopped by taxpayers, many had hoped that the rescue by UBS would be a catalyst for change. Perhaps the federal elections in October could offer an opportunity for debate, but many feel that moment may have already passed. Another concern, Switzerland is a very small country, but its banking sector underwrites financial risk all across the world. Now, UBS total assets stand at 198% of Swiss GDP. On the surface, all is calm. Unemployment unmoved, inflation the envy of every central bank, and the money in the banking sector, it still flows. But if crisis does arise, does Switzerland have the firepower to meet it?
Well, Bloomberg's Oliver Crook there with a look at the aftermath of Credit Suisse's collapse. You can read more on that in today's Big Take. Just go to NI Big Take Go on your terminal or visit Bloomberg.com. Coming up, 30-year Treasuries are heading for their worst week this year, so we'll have plenty of market chat. That's coming up next, and this is Bloomberg. The conversations that matter, the insights you need. This is The Pulse. I'm Francine Lacqua here in London. Now, Treasuries pause their sell-off ahead of the highly anticipated U.S. employment data later today. Now, we're joined by Bloomberg's Eddie van der Walt. Eddie has had quite a week. He's been looking at Treasury moves like minute by minute, Eddie, so you probably need to lie down after the U.S. jobs report. How do you look at the Treasury moves? Is it because there's a worry in the markets that they won't be able to absorb the $102 billion of issuance, or is it something deeper?
Yeah, it's a confluence of factors, really, right? It's been a little bit of a perfect storm in the Treasury market. We had the Fitch downgrade, then we had this new issuance, and then on the back of that, a lot of people just re-looking at their positions. Now, the long Treasury trade, the long duration trade has become a little bit extended. A lot of people went that way because they thought that steepening was, coming, but that it was going to, occur not in the way that we're seeing it here, not with the long end rising significantly. And I think so. That's caused a lot of questions for a lot of people who've taken this long exposure. Now, we have seen about 40 basis points of steepening between the 2-year and the 30-year. Of course, back in March, we had an actual deeper steepening. We saw something like 100 basis points on the back of that, the banking crisis, but that was across the curve. This was much more focused on the 30-year, and that makes it worrying. But we're moving towards jobs, and that's going to give us a lot of new data to digest.
So, Eddie, what are you looking most forward to when you look at the U.S. jobs data today, the non-farm payrolls? Again, is it the overall number that gives us an indication, or really is it just wage growth? But also, it's unclear how the market would interpret it. If you have a better than expected figure, it's also because maybe people want to come back to work because they worry about personal finance.
Yeah, absolutely. Just because you're going back to work does not mean the economy is growing gangbusters. It could be that people are worried about their spending and so on, and that they are being forced into that position, which is a very different thing. But the implications for the economy is interesting, right? If you're forcing people back into work, if people do have to come back, if we see the participation rate, in other words, ticking higher, then that means that we're taking pressure off wage growth, right? There's something like if the participation rate's still significantly below where it was pre-pandemic, we can still get about 500,000 workers back into the economy with no pressure on inflation. So the economy is not growing at capacity at the moment. We still have these free workers out there. So they could come back, put downward pressure on wages, and that may just unwind all of these moves that we saw in the steepening moves. That was basically a bet that inflation is going to remain sticky. And we could see that unwind a little bit if we see that feeding back into wages and into CPI next week.
Eddie, is there something else that you're looking out for in the next? I mean, there's CPI next week, but overall, there just seems to be more of an alignment in a lot of these central banks and what they're trying to say, which could be as simple or difficult as, look, rates are going to have to stay higher for longer, and maybe that's a more effective way of dealing with policy rather than actually continuing to hike.
What we've been hearing more and more from central bankers, of course, is data dependency. Data dependency, we've got to remember, implies volatility, because it implies with every new release, the central bank is no longer giving you forward guidance. It's no longer telling you, hey, we're going to hike rates next time around. So we all know what's going to come. And, we look beyond the next meeting. Now they're saying, hang on a second, we don't know what we're going to do at the next meeting. You've got to look at CPI and reposition. You've got to look at non-farm payrolls and reposition. You've got to look at PMIs beyond that. So every new data release sets us up for volatility ahead of every meeting, because we don't know what the central bankers are going to do. Which data are they depending on? So it's actually a really interesting moment in markets. So I think that's the big one. The other big one, of course, is the oil price moves that we've seen. We've seen the Saudis saying they can extend those cuts. They've said they could perhaps even pump more. So I think that's the other one, because that could just fuel inflation a little bit more at this moment in time where we're seeing it coming off.
Eddie, thank you so much. Bloomberg's M Live, Eddie van der Walt there with the very latest, of course, on all of these markets, treasuries and yield curves. Coming up, law and order becoming a major battleground ahead of the next general election in the UK. So we'll have the details next, and this is Bloomberg. Welcome back, everyone. Crime fast becoming a major battleground in the UK ahead of the general election as a public trust in the police has fallen sharply. Well, joining us to discuss all of this is Bloomberg's UK government reporter, Emily Ashton. Emily, first of all, congratulations on a really important story that maybe we don't spend enough time on. We'll push it out also on social media. It's called Look, Sunak says UK crime is falling, Britons are not feeling it. And you went to Middlesbrough in northeast England to try and figure out, you know, what the situation was like there.
Yeah, I think what we've realised in Parliament is there is a disconnect between what is said in Westminster and what people are feeling on the ground. So in Westminster, you hear from Rishi Sunak, you hear from the government, police numbers are going up, crime has halved in the last decade. Well, on the ground, I don't know about you, but I hear from friends and acquaintances, well, yeah, something got stolen and the police didn't even bother to show up, or people don't feel like the basics are being done when it comes to the police. So the reason we went to Middlesbrough in northeast England was because that is a crime hotspot of England. The rates of crime are high, particularly serious violence, antisocial behaviour is quite high. So it's just having a look there to see kind of people's experiences on the ground. It's also a really interesting spot politically, because in the Red Wall in North England, that used to be very traditionally Labour. Lots of people turned to the Conservatives after the Brexit referendum, but actually people there now are quite disillusioned with the Conservatives because they're not getting what they want from them in terms of basic services.
And Emily, this is not only for the least affluent communities where this is happening.
No, this is about a fall in trust nationwide. You know, this is about people feeling that if they call the police that they're not going to get the basics done. So I also spoke to somebody in Bournemouth, this lady whose father had his car stolen from his driveway overnight. She called the police, wasn't happy with the response. So actually she took it on herself to post on Facebook, lots of different Facebook groups, that this had happened. She went around petrol stations, shops, and in the end they tracked it down. The family tracked it down themselves, and she said, you know, if I hadn't done that, we would not have got that car back.
So this is going to be a hot spot really for the election.
Yeah, and it already is. You know, the general election is probably next autumn. We're thinking it has to be by January 25, so it's hotting up already. Labour this week alone has put out 2 or 3 press releases about crime and how things are deteriorating under the Conservatives. And remember that the Conservatives used to be very strong on law and order. That was their thing. Well, now the polls show that Labour are actually stronger on that. And they think that if they can show that they can tackle crime better than Rishi Sunak, then they've got a real shot at winning the election.
Emily, thank you so much for this really important conversation. Of course, you know, I'd love to get you back on to try and figure out whether this is a cost of living crisis or it's really also just a defunding from what the government has done. Our Bloomberg UK government reporter there, Emily Ashton. Up next, Bloomberg Surveillance Early Edition with Guy Johnson and Kriti Gupta. They'll talk yields. Remember, it's a U.S. non-farm payrolls as well, so they'll have market action, they'll talk about the UK, and they'll talk central banks.